for the big picture. For that, let's welcome in the team from Charles Schwab. Nathan Peterson is Director of Derivatives Analysis at Schwab Center for Financial Research, and Cooper Howard is Director and Fixed Income Strategist for the Schwab Center for Financial Research. Nate, Cooper, great to have you both here with us. Nate, let's start with you. Stocks really struggling to find direction today. Dow, NASDAQ, and S&P all just barely positive, but it is a losing week for stocks. When it comes to technicals, what specific levels are you looking at? What stands out to you from a technical point of view?
Right. Hey, afternoon, Caroline. So normally, you'd look at that 50 SMA and say, well, we've kind of been backing off that today. The NASDAQ 100 was above the 50. It's pulled back. The candle's looking kind of weak. But honestly, I think that what's more important is that, number one, the 4,600 level that we backed off of, that resistance level in late July, and then 4,350 is a level where we found buyers both in mid-August and back in mid-June. And I think those are really the more important levels. The 50 SMA on some of these has begin to kind of gone a little bit more sideways. So when you're in an uptrend and you break one of these moving averages to the downside with a significant breach, that could be more significant than when you're kind of chopping sideways and looking for direction. And right now it feels like we're in one of those periods where we have, bearish seasonality in front of us. There's not a lot of catalysts. We're out of earnings season. We do have CPI and PPI next week. Maybe that could provide some direction one way or the other. But I will say oil prices have been pretty hot, and I'm just wondering how that's going to affect next week's reports.
All right, we'll talk more about that report in just a second. But Cooper, just in terms of rates, investors obviously have been very focused on rates, not just this week, but overall, really over the past month or so. We did see a tick lower in the 10-year yield today. But what's your key takeaway from this week in terms of the rate action that you saw?
Yeah, I think the big key takeaway was all the Fed speak that we heard this week. There was quite a bit of it, so you really had to open up your ears to hear a lot of what they were saying. But I think really if we take all of in culmination of kind of what they had said, is that I think that they're relatively satisfied with where the direction of the economy is going and where the direction for inflation is going. Now, the job likely isn't done, so I think that what that means in terms of the Fed function is what is going to be the next step. I don't anticipate another rate hike during this cycle, barring a major surprise in either inflation or in the labor market picture. But I think that it's looking forward to seeing how long are they going to continue to hold rates at these elevated levels. So I think that that was kind of the big story of this week, all the Fed speak that we really heard from.
So Nathan, if stocks are going to continue to trade on rates and Cooper says the rate hike cycle might be done, what does that mean for where stocks go from here?
Well, if you look at the 10-year, we're still in an uptrend, and we're basically about 10 basis points away from that new cycle high at 4.36%. And we also know that some of the ascent here in the bond yields has been to the higher for longer thesis because of the stronger than expected inflationary data. It's also been a little bit from the high treasury issuance that's been out there. So even if inflation does cooperate, as it has been in terms of its deceleration, it seems like there's some other factors out there that potentially can be pushing to higher yields. Now, I'm not suggesting that they're ready to just take off, but I am suggesting that if the 10-year does continue in its uptrend and makes a new cycle high, it's hard for me to see how that's going to be bullish for stocks.
Okay. And Cooper, let's really kind of home in on next week's CPI report, because that, of course, will be the highlight. We also have PPI. We also have retail sales. Weekly jobless claims, I'm sure, will be closely watched. But in terms of CPI, what specifically should we expect?
I think what we should expect is if we look at the core number, it's going to continue. It's expected to move a little bit lower than where it was the prior month. However, it is still elevated for what the Fed is looking at. So if we look at kind of how to break down rates, I look at it kind of as a math puzzle. So there's multiple different pieces to it. You can look at a Fed funds rate combined with the outlook for inflation, the outlook for growth, and kind of build on top of that, maybe a little bit of a fudge factor, if you will. And so if we look at what inflation could actually mean for what the Fed might do, I think like Nate was saying, really it's the story about the higher for longer and how long are they going to continue to hold it. Now, given that it's likely that the rate of inflation will continue to move lower, I don't expect that will change the direction of the Treasury in the near term. Now, if there was a surprise to one side or another, then yes, that could give us some direction for a higher yield. But longer term, what we're actually expecting for the direction of interest rates is I would not be surprised if longer term yields continue, if they move lower from here. So what that means for our investors, what we've been suggesting for them to do is we've been suggesting take advantage of this recent move up in yields, lock in longer term yields and extend duration. One strategy to do that we still follow through with is a ladder that can be beneficial for long-term investors.
All right, we have to leave it there. Cooper Howard, Nathan Peterson, both from the Schwab Center for Financial Research. Thanks for giving us the big picture.